Good. Thank you very much for having me, and particularly with the weather condition and also for the physical attendance here. I think this is quite important to encourage our panelists to have a good discussion. Thank you for the support. So I'm Rico Zhang, the Senior Director with the International Capital Market Association and also the co-chair of the product group at the GFA. This is a very interesting journey to witness the developments in the Hong Kong green finance over the years, and I have seen many familiar faces and also new faces into this interesting sector. I think this is important because, as you know, the recent headwinds against this agenda, and also we have some tariffs, global economy slowdown, and some geopolitical situation. So it's meaningful to discuss further how we drive this, particularly when we sit in Hong Kong. We face sophisticated international buyers who look for sustainable assets with global standards. Meanwhile, in Asia, we have many emerging markets. They are challenged to attract private sector capital to support their agenda to transition from traditional economy to more sustainable way. So I think we have a full house of different experts, particularly with the financial institutions, and we want to bring in some interesting perspectives and also share such views on how to help the emerging markets and match the demand and the supply when we sit in Hong Kong. So before further ado, I maybe just ask each panelist to briefly introduce yourself and what your coverage. Maybe from Justin?
Okay, thank you, and good morning. Really happy to be here. I think this is my second time at this panel at the HKGFA, so always great to be at this event and see this agenda sort of here. So I'm Justin. I'm head of climate change for Asia Pacific at HSBC. So I think the two things I do in my role is, one is, I help navigate our climate commitments within the bank, and of course also help support our clients in terms of transition journeys and their green financing needs as well. Thank you.
Great, wonderful to be here. Hello everyone, my name is Rahul. I'm based in London and I lead the sustainable finance team at Moody's Ratings. So we really focus on two things. So the first, how do we capture climate and sustainability risks in our credit ratings, which of course we're very well known for. But beyond that, how do we also provide an independent view on the credibility of entities' sustainability financing programs and their decarbonization strategies as well. Thanks for having me here today.
Good morning, everyone. Thank you to HKGFA for having us again and having us as a sponsor again at SocGen. It's wonderful to see so many faces and friends in the audience despite the weather. My name's Tessa Dan. For those of you who don't know me, I'm the Head of Sustainable Finance for Asia Pacific at SocGen. I look after origination and execution of sustainable finance transactions for our clients across many different sectors and across all of APAC.
Hello again, everyone. Marisa Drew, the Chief Sustainability Officer at Standard Chartered Bank. And my role as the CSO is to help set the sustainability strategy for the bank, to produce our ambitious public commitments, to deliver on those commitments, to look after our decarbonization program, which we call the Net Zero Platinum Program, and as I mentioned earlier in my opening comments, to help set up the innovation activity that we have within the bank to try to drive sustainability development across the ecosystem and some of the trickier topics that we all face.
Thank you all. Maybe I should do the same because probably a lot of you know about ICMA. We basically the trade association for the debt capital market. Traditionally, we cover primary, secondary, and the ripple markets. And now, famously, because of the green bond principles, we set the standards for the bond area and different products and also guidelines. So many of these are members to ICMA, and also we work with HKGFA very closely. So let me kickstart the discussion by maybe starting with Justin. So how are the technological developments and the trade patterns affecting national climate change in Asia?
Yeah, thank you. It's a big question for the morning. I think we had, I think in the speeches this morning and also Dr. Ma's panel, I think we touched on this topic quite a bit, and I think it's a very interesting one, right? And obviously, a lot of events now lead with this sort of question about, okay, what is sort of change in the external environment, and how should we all read that? The first thing I want to say on that is that national climate and decarbonization strategies are long-term, and we must take a really long-term view towards them, right? So what that means is that they're going to be subject to ups and downs, twists and turns, but over time, we need to see where things are moving in this trajectory. So since we're sitting in Hong Kong and we talk a lot about China, I think China is a very interesting example of this long-term view, right, of how a national decarbonization strategy has produced outcomes and what that actually means and how that could have an impact. So the first renewable energy law was passed in China in 2005. I remember that quite clearly because that's around the same time when I actually started my career as a renewable energy analyst at that point. And I remember having to do forecasts of how much wind or solar could actually be built in China in 10, 20 years. Drawing lines on a chart, doing spreadsheet. This was before the age of AI, by the way, so you had to actually do everything by hand. And actually, I think what China did a little while later was set a target of about 1,200 gigawatts of wind and solar to be installed by 2030. So last year, that number was 1,400 installed. So about 6 years ahead of target and actually exceeding that, right? So I think it's a really remarkable achievement and something that we can't really actually, could not have really predicted at that point. So I think on the first point is that having that long-term strategy can really make a difference and really scale an industry. The second part of your question was about trade patterns and other things, right? So I think as a result of that, another interesting observation we see now is what's happening on the trade side. So again, there's a lot of discussion about trade. Is that going to have an impact on the transition? A lot of this trade is, obviously targeted at China. Again, I think it's useful to take a long-term view. The first tariffs the European Union put on Chinese solar panels was back in 2013. So this is not a new thing for this industry to navigate. It's not to say that it's not challenging and it will not have an impact, but clearly it's not a new piece. But again, what we see is that actually these trade patterns are reconfiguring, the way that things are flowing. So between 2021 and 2024, there was about $44 billion of Chinese solar exports just to the global south, not to the EU, not to the US. And Saudi Arabia and Pakistan were actually the two top countries in terms of receiving it. So again, I think in some ways, I think while we can talk about changes in policy, we can talk about trade barriers and all these sort of things, but at a moment like this, I always like to go back and look at actually the numbers of what's actually happening in the real world. And a lot of these things I think look really promising. And it's up to us to think about, okay, what does this mean, right? This growth of a massive Chinese renewable energy industry, increasingly a South-South trade in climate technology. I think that's a significant opportunity for us, but actually it's an optimistic message as well in terms of what we can do to combat climate change.
Thank you, Justin. And to continue on this national and the global dynamics, maybe I want to touch on the certain points on with Tessa. So how have market developments and the shifting dynamics impact and momentum in sustainable investment?
Yeah, thanks, Rico. So I think the most important point, which we've sort of heard reiterated this morning, is that the market noise is not necessarily a reflection of the reality. So, looking back over the last 5 years, I think, everything was sort of pointing in the same direction over that period of time, towards increased robustness, alignment of policy settings that were focused on decarbonisation and energy transition. And so this year is really the most prominent year of divergence between markets. And so everyone has sort of been focusing on the risk of contagion from the US. I spent a lot of the first couple of months of this year speaking to clients about making sense of what was happening in the US and how it may impact other markets. Overall, we see that corporates, asset owners, and developers say that the sustainability topics remain at the top of their agenda. However, perhaps with more of a pivot towards those more stable jurisdictions, which will, hopefully stay the course and even accelerate their ambitions. The earlier remarks around risk and uncertainty, obviously being sometimes bad for the economy and for investment decisions, and so that shift towards more stable policy, safe harbours when it comes to energy transition, I think, is definitely what we see, and I think as a result, Asia will really benefit from that. We've seen already, and we hear from our European colleagues at SocGen that European partners now seek investment in APAC deliberately. And so I think, to the title of the panel, Recalibrating the Pathways to Net Zero, it really is a recalibration in terms of where that investment is happening and which countries will drive the transition forward. So, of course, time will tell, but as we've heard, China is going to be a big driver of that, and APAC as well. And we really see that in terms of clean tech as well as clean energy. There was an article from Bloomberg recently about the number of clean tech patents being approved in the Chinese market. And for, it's probably for another day, but a huge increase in terms of the number of patents being filed around clean tech innovation. And so really seeing China and APAC cement themselves in terms of those supply chains globally, and supporting the future of those supply chains as well, and the innovation around those. Additionally, I think the aspect remains, and there's so much focus now in terms of translating sustainability ambitions into economic realities. And so, as financiers, we also have that power still, and even more so, to finance the transition, delay it, or support it. So the economic advantage remains key in terms of translating and demonstrating where money being spent is resulting in returns. When it comes to ESG investment and what's actually happening with ESG investment figures, I think there was a concern that responsible investment funds under management would reduce due to this market noise through the first half of this year. But we've actually seen that some managers are pulling funds from some mandates and shifting towards those which have more strong ESG commitments. So we've seen that over the last week in terms of some of the headlines that are playing out. A couple of other examples. The European market is still incredibly strong in terms of demand for sustainable bonds. We saw an issuance last week from KfW, the German Development Bank, which had a record order book just last week, so 16 billion euros of orders. And that's just one example, but it's not an anomaly. Additionally, even though we have seen some banks withdraw from the Net Zero Banking Alliance, those banks have still maintained their sustainable financing targets. So SG, we have a target to achieve 500 billion euros of sustainable financing by 2030, and many of our other peer banks have those targets as well. And again, that point that just because some of them have left the Net Zero Banking Alliance does not mean that they have reduced their appetite in sustainable finance. And we saw also one last example. A data center operator in Asia Pacific made some recent announcements that 16 billion of their debt financing is in green or sustainability linked format. So very large numbers still, and these are recent examples. So I think we just need to, all collectively push in terms of continuing the momentum. And as I said, finance has the ability to delay the transition, but also has the ability, importantly, to support it.
Thank you. I think that's very interesting and also encouraging, because maybe I have heard some feedbacks from the other side, but I think it's important to continue this effort, and with everyone, particularly in Asia, we have a heavy load to really just make the economy more sustainable. So as I said, the crucial is to attract the private sector and mobilize them into those projects, and more like controversial is about like a transition, because to certain investors, they think this is not green enough. But how to make brown so-called transition into green, I think that's the topic, and still highly debated these days. Maybe I want to ask Rahul, because like Moody's obviously on a lot of those projects. So how is private capital being mobilized to narrow the climate transition financing gap?
Yeah, thanks, Rico. I'd like to start by grounding all of us in some numbers around the climate investment gap. So last year, there was around $2 trillion globally of energy transition investment. So that's everything from your sort of now bread and butter solar and wind, through to more exotic projects like energy efficient data centers and next-gen nuclear, for instance, as well. So $2 trillion globally. That leaves a transition gap of around $2.4 trillion annually by 2030 if we're going to meet a net zero pathway. $2.4 trillion, that's around 1.6% of global GDP. So how do we bridge that gap? Well, of course, governments are going to have to step up, and we've heard about the leadership from China in many of the conversations earlier today. But many governments have got pretty stretched balance sheets post-pandemic. They're jostling with other priorities, whether those are defense and security related, or education and health. So it's going to be critical for private sector capital to really scale up. And we think, and I would say this coming from a credit rating agency, but the debt capital markets are going to really be at the forefront of this. Not least because there's a significant amount of credit exposure. So at Moody's, we publish an annual environmental risk study. And in our latest study, I can tell you that there are 16 sectors with $5 trillion of Moody's rated debt that face elevated credit risk from carbon transition. So companies in these sectors, from autos to aviation or shipping to steel and oil and gas, they are going to have to address policy and market shifts. They're going to have to decarbonize their operations and their supply chains and invest in new green revenue streams. And many of those companies will do that successfully. Others will also have to wrestle with the fact that there is policy risk, there is higher capital cost, and there's investment in emerging technologies that may not be viable today. So the risk of capital misallocation is also a real one. So putting this all together, what does this mean for the private sector? Firstly, we do expect to see transition-related debt increase and accelerate pretty significantly. It was around $1 trillion, both labeled and unlabeled last year. We think it will get to around $2.5 trillion by 2030. But importantly, companies in hard-to-abate sectors will have to convince the banks and the investors amongst us by articulating well-thought-out, credible, and importantly, business-relevant transition plans to really articulate how they're going to implement those successfully, how they're going to align with new taxonomies around credible assets and activities, and how that's going to impact their credit profile over time. And we really do think Asia is going to be at the forefront of that story. We provide independent opinions on the credibility of sustainable bond frameworks and entity-level transition plans. And I can tell you that our global footprint in Asia is almost 40%, and that's double from where it was just 2 or 3 years ago. So as that demand for credible transition in the private sector starts to accelerate, I think Asia is going to really be at the forefront of that story.
I think I can supplement just from my perspective. I want to remind everyone from ICMA standard point of view, probably this is from our membership who actually on the stage, for example, there's no transition bond labeling. I want to remind everyone the transition is more on the issuer level. So at the product level, you can consider either the user proceed bond, the green bond, for example, or the SLB, right? So that's sometimes confusing enough because we witness in Asia, some Asian countries, they're like transition bonds, but that's complicated. And I think it's important to have a credible, like Rahul said, like the pathway, because transition is about indeed the pathway, right? In certain jurisdictions, you have certain like a transition taxonomy. Maybe that's not good enough to the global investors. You should also have a more ambitious strategy how to transition to net zero, and then communicate your strategy with the investors. I think that's important. But beyond the like a labeling issue, like from the instrument perspective, maybe I want to ask Justin, like how is HSBC looking at the transition financing, as I said, beyond those labeled instruments?
Yeah, I think pretty much you two just answered the question. No, I fully agree with what Rahul and what you said as well. I mean, one is that obviously there's growing set of activity that's happening beyond labeled finance. Secondly, I think one way that we and I think probably some of our peers as well are looking at this is that commonly, of course, one is what you said, also looking at transition plans and pathways, right? Whether certain activities that corporates or others will do, what role does that play towards its transition journey or plan, right? And I think that's sort of a much more holistic and think broader way of looking at it. The other thing is just looking at the ecosystem, sort of particular ecosystems. So for instance, we know that clean electrification is really the backbone of the energy transition, right? But clean electrification is more than just a lot of new generation capacity such as solar and wind. That's very important, but there's more than that, right? There's lots of infrastructure. There's now growing energy management systems and adopting AI and other things as well. So these are sort of newer areas which I think in some cases we need to find ways to kind of support these ecosystems, right? And they're in some ways going beyond, I think, traditionally labeled activity. And then the other area I think you've also mentioned, Rahul, is sort of emerging climate technologies. We know that there's a number of technologies that actually are early stage. They need to be so-called catalyzed or brought to market and things like that. Those are sort of emerging areas as well that we need to look at. And I think it's again I want to say this because it's not to say that obviously all this work that we do on taxonomies and labeling is not important, right? This is sort of the whole premise of all of us being here and talking about this topic. I mean, that of course is important in sending signals to investors of developing a market and doing all those things. So that work I think definitely needs to continue, but at the same time, I think we need obviously greater flexibility of different categories and to sort of meet the different needs of transition as it becomes more embedded throughout the economy.
Thank you, Justin. And Marisa, maybe with your work at Standard Chartered, how has your conversation with the issuers similarly involved?
Sure. So it is, as was pointed out, somewhat tricky in the sense that we tend to all feel we know what is green. Green is green. We know what is brown, but transition can be a little fuzzy for people, and that lends itself to, I'd say, sometimes I would say either reluctance or a bit of confusion from an issuer's point of view to put themselves out there with any kind of labeled instrument without that sort of clarity. So our first step in attacking this was to actually publish a transition framework where it's very, very comprehensive, extremely detailed, where we lay out specifically what we think it does qualify under transition. And this is a living, breathing exercise because what would be acceptable as a transition activity 6 months ago may not be as newer technologies come to the fore and are adopted. But in the absence of that, we think if we're very transparent about what we call transition activity and what we will support behind that, then that helps to give clarity to our issuers. Then we have an active exercise of engagement. So as we have mapped all 12 of the hardest to abate sectors, which is a really complex exercise in a bank like ours. We have 50 footprint markets that are all at different places on these journeys, and every client is at a different place within the country level maturity curve. We need to meet clients where they are, but we engage with them on our expectations. We are very clear that we have set targets, 2030 interim targets, and then all the way to net zero by 2050. We're not relaxing those. We're very committed to deliver. And on those pathways, which are all scientifically based pathways, we then have that conversation with clients. And then the really interesting thing is, I would say that when we were endeavoring on this exercise a few years ago, many of our coverage bankers were thinking, oh my gosh, we're going to scare our clients. They're not going to want to engage on this. They're going to think that we're pushing them faster than they're ready to go. But the fascinating thing is most clients want to be party to this movement. It can either be because they see it as a commercial opportunity and differentiation point, or if you have, as Moody's pointed out, the risk lens. Either way, it is a very, very important topic and a C-suite topic for our clients. So they're very open to having that dialogue. And then what we want to say to our clients is we're here to help you finance that transition. So if you're willing to go on the journey with us, our whole raison d'etre as a bank is to provide the capital to help you do that. And we find that to be a very easy and open conversation. The other, what I'd say, quasi-new thing, if I can put it in those terms, around the transition world is what we internally are calling the concept of a pure play. So we have said internally that if there is a company whose revenues are more than 90% derived from a transition activity, we call that company a pure play. And everything we do with that company would be under the transition banner because almost by definition, everything they're doing is headed in that direction. So it could be anything from a critical minerals company whose 90% of the revenues are going into say vehicle electrification, for instance, or it could be a myriad of other component parts manufacturers where they can demonstrate to us that the end product is something that is decarbonizing the economies or their industry sector. So those are the types of evolving discussions that we've been having, and I have to say what I find pretty encouraging is not only are they happy to engage, but there's almost this, I would call it race to the top, where once you start to have these dialogues, you watch this almost phenomenon take hold within their companies where they're challenging themselves to do more and more and more and more. And they can't wait to show us how it starts with, simple things like putting solar panels on your factory, and then all of a sudden it's integrated into everything that they're doing as a business. And that's where I think, we can sort of see the end game here really being something that is achievable, even amidst, all of the noise that we've been talking about earlier in our sessions today.
I think I totally agree, and I think we actually have had a report to examine the transition, what really transition means. So we basically have 3 categories: the economic-wise transition, then down to the climate transition, and further the bottom layer is the hard-to-abate transition. Now, to make the carbon neutrality net zero success, it's very important to focus more on the hard-to-abate transition, which right now, at least from the debt capital market, it's not enough. So I think it's crucial to continue such dialogue and engagement with different stakeholders, particularly the investors. Now, we touch on the credibility about those transitions. So let's move on to talk about that. So Rahul, why are regional and sector pathways important in accessing the ambition of the targets, and our investors are starting to take a more nuanced view when assessing decarbonization strategies?
Yeah, thanks, Rika. I'd like to offer a poser to our audience, both in the room and online. So would you prefer to lend or invest to a carbon-intensive company with a 1.5 degree long-term target, but no real plan to get there, or perhaps even worse, the technology will magically appear in 2045 to decarbonize? Or would you prefer to lend and invest to a hard-to-abate company that has a 2 degree target, perhaps even an above 2 degree target, but it's well costed with transparent CapEx plans, a clear timeline around phase out of carbon infrastructure, and a phase in of new technologies? Well, these are some of the questions that we've been asking investors, and maybe I'll share some of the feedback that we're hearing. So number one, the sort of binary focus on 1.5 degrees is increasingly being challenged. And it's being challenged not least because of the policy settings we find ourselves in, but also, and Marissa's sort of alluded to this, that not all sectors need to be net zero emissions by 2050 to be on a net zero aligned pathway. So that's number one. Number two, the emphasis on implementation is only going to increase. And with that, does your transition plan generate return on investment? Are you going to see material cost benefits reductions as a result of implementing that CapEx? Are you going to unlock new green revenue opportunities as a result of that investment? And then the third point that we're hearing, and Rico to the point on regional pathways, is net zero implementation is not a one-size-fits-all story. And regional context is really important there. So in our net zero assessments, these are opinions that we give on the credibility of companies' transition plans. We take into account regional pathways because that nuance is important. So a company with operations largely concentrated in emerging markets with the same target as a similar company in an advanced economy would typically score higher for ambition, and especially in the short term. And that's because in regional benchmarks, they take into account the fact that in many emerging markets, the starting point is much more high carbon, and the level of carbon intensity reduction required will be less significant. And this isn't just theoretical. We've seen this in practice. We provided a net zero assessment for CLP Holdings earlier this year, and CLP Holdings has a significant emerging market footprint. It outperformed the regional pathways, and we gave it credit to on that basis. So regional context is really important. It's not a free lunch because many emerging markets will face implementation challenges, whether it's financing constraints, whether it's faster energy demand. But we need to take both a regional and a sector view when we're applying our analysis and the credibility of those plans.
I think that's important because, as you said, we should consider the regional context and the sector context. I think there's a certain a mismatch as I see, most of our membership, for example, from ICME side, they are global players. But when you come into this, particularly the Asia-wise jurisdictions, they have different mandate, different agenda, and different targets. So how to tailor those demand and match such a financing gap, I think that's crucial. And I would definitely encourage the global players to consider these kind of regional colors and how you have a more, I would say, well-applied approach to engage those clients and also the different financing need. Tessa, I want to also ask, what future-proof clauses would you add to an issuer's transition playbook?
Thanks, Rico. So I think it's a couple things. Firstly, it's not set and forget, and it can't be set and forget. So borrowers need to ensure that they're adapting to shifting expectations over time, whether that's changing market standards or approaches, whether that's changes to pathways, because things can change overnight. If a new technology, to Rahul's point, you may have an inflection point where a new technology can really accelerate decarbonization in a particular sector. And so you need to, just because your prior strategy was aligned to 1.5 or 2 degrees, you should continuously take that opportunity to shift your approach and improve over time. Secondly, continuing to ensure a focus on the financial impact and opportunity of your transition strategy. We've talked about this, I think everybody has mentioned this, in terms of translating, and I said before as well, translating the sustainability strategy into economic impact. One anecdote is even in the US market, we've heard of investors actually saying we prefer the sustainability-linked format, sustainability-linked loans, even in the current context, because there is a financial benefit. It's direct, it's tangible, and it's part of the transaction embedded into it. So, don't believe everything you hear that sustainable finance is under attack in the US necessarily. There's pockets, particularly where you can demonstrate that financial impact. Additionally, it goes sort of back to my first point, but it's a little bit separate in terms of maintaining alignment to updated market standards. So we continuously revisit existing market frameworks and borrower frameworks with our clients. So updating them over time, again, not set and forget, and ensuring that your approach is aligned to best local and international standards. So if there is a gap, either with the local standard or international ones that are prominent, it's definitely best practice to be able to articulate why those gaps exist. What exactly is it about the way that you operate your business or your sustainability strategy or the market dynamics that may prevent you from aligning to those markets, international expectations. Additionally, being involved in shaping the standards in your industry. So in the banking sector, SG is involved in many of these industry consultations and product development guidelines. The most recent one is the APLMA, LSTA, and LMA have together been working to draft a transition loan guidance. So, this is in the financial sector, but of course in each of our sectors, there are sustainability and net zero partnerships that you can be a part of and really drive that change. And lastly, a focus just on adaptation and resilience. So future-proofing your transition strategy is also about future-proofing your assets, your investments, and your business to be climate resilient. So continuously taking opportunities to reflect on how the investment decisions that you're making that support a sustainability strategy can be perhaps taking into consideration or more deeply taking into consideration adaptability and resilience to the impacts of climate change. So quite a lot to think about. It's not simple, right?
Yeah, I think certainly the debate continues even at the ICML level, and I believe with different like industry bodies, this is just a hot topic over the last few years, and it just continues. So I think it's good to share such perspectives from different angles, and maybe it's helpful to reach a consensus, particularly, again, in Hong Kong, interestingly, we sit in the between the global and the regional sort of like the demand and the supply. So I think more conferences like this actually will help the dialogue and the communications. We have heard enough about the debate about how you engage your clients and how the sort of like a macro recent trend affect the transition journey and how we respond to those new patterns. Maybe turning internally. So Marisa, let me turn to you. How are you operationalizing your own net zero strategy?
So it started for us by setting very ambitious targets. If you have something that everybody knows internally inside your organization is your KPI or your North Star, the organization tends to rally around that. And as many of our panelists said, if it was just about decarbonization and only about net zero targets, I certainly can say from a banking point of view, the absorption of that on the front coverage side would have been, this is a tax on me. You're taking away business. This whole decarbonization thing is pushing, again, our clients ahead of their readiness, et cetera, et cetera. So when we set our net zero commitment, we married that with two revenue-oriented public commitments. One, and many of our peer banks have done the same, or I'd say most of our peer banks have done the same, over a 10-year period, we call it a mobilization target or an underwriting target. And we set ours at $300 billion over 10 years. But we also felt that we needed something that was much more near term, so we set a sustainable finance income target for the end of this year. So this was back in 2021, 2022. We set a really, really audacious goal for ourselves of $1 billion of sustainable finance income by the end of 2025. I can tell you when we set that target, everybody thought we were crazy. You know, how are we ever gonna do that? And guess what happened? In the midst of everything that's been going on, last year we hit $982 million of sustainable finance income in 2024. So effectively hit our target a year ahead of schedule, whilst we hit every single one of our emissions targets on the reduction side for our net zero program. And it was the combination of those two things where you could show the pathway to the revenue opportunity at the same time you were decarbonizing that put the switch, I think, into our colleagues' minds that you could engage on the topic while finding new sources of revenues for the bank. So that was the number one ticket. The second thing we did is we very, very carefully mapped every one of those segments, as I said, all 12 of the hardest to abate segments, setting our 2030 targets, and then we made it a hard scorecard topic. So those targets, we set a risk appetite against, with a headroom against each of those pathways to 2030, and we put it into the scorecard that if we breach the risk appetite, that goes all the way up to the chief risk officer and the board. Talk about a way to galvanize opinion. When it's in the scorecard as a risk matter, it is there. Next thing we did was we said we need to train all of our front coverage officers. So we set about with initially what I would call Sustainable Finance 101 training as a mandatory matter. And then we've increasingly created customized training modules depending on regional nuances, depending on product specialities, whatever, and we're rolling that out consistently across our front coverage force. Next thing we did is we wanted to arm our front coverage officers with very easy to understand and easy to use tools. So we used data and we used automation to flag for our coverage officers where their clients are if they're in the hard to abate sectors along that curve. And then anytime they want to do a loan, is that loan going to take you above the line, or is that loan actually going to take you below the emissions line? Doesn't mean you can't do a transaction above the line, but we mandated for each of those hard to abate sectors a responsible coverage officer, industry sector coverage officer, to look at it on a portfolio basis. And they're responsible for getting us to net zero ultimately in the 2030 targets for their industry. So if there was very strategic reason to do a higher carbon emitting transaction on the one hand for one client, the portfolio approach will mean that you're going to have to make it up by doing decarbonizing transactions below the line. And then last but not least, we've integrated all of this into our capital allocation part of our house. So anytime we want to do a loan, if there is a risk officer that's making a determination to allocate capital in that direction, we have a very healthy debate about how strategic is this if it's a higher carbon emitting transaction. And then for all of those clients who are in the hard to abate sector, we have absolute plans with every one of them about how we're going to engage, how do we want to be a partner of choice to help them on the journey, whether it's financing new technologies that'll be the breakthroughs, whether it is that process improvement work that we talk about, just those little things that will get the emissions down for that client. So it's pretty comprehensive. It's not a one size type or one silver bullet. It is sort of what I would call a constant exercise, because what you're trying to do is really transform an entire way of doing business.
Thank you, Melissa. That's very interesting and impressive. And I think your bank did a very good job, because I also seen some very good commercials about your bank's commitment to this as well. So it's very interesting.
I would say only lead with substance, not marketing. So behind every one of those commercials are some pretty good proof points, like our 982 million.
Yeah. So Justin, your bank probably have some similar stories. Maybe you mind sharing with us as well?
Sure, yeah. I mean, I think the comprehensive approach, right? I mean, it's definitely agree with that. I think it's fantastic. I mean, the journey typically starts with the target setting, the commitments, the science-based pathway, understanding actually what is needed to achieve net zero, what are the industries and technologies that you need to scale. I think one thing that we always say is that the transition really is a two-stage sort of approach, right? One is that the technologies which are commercially viable today, how do we scale them, really bring them out? These are things like renewable energy, batteries, et cetera. And then the next generation climate technologies, how do you sort of bring them to market? So I think within HSBC, we've always taken a very science-based approach in thinking about what we actually really need to do to really have that impact, right, for our clients and for the industry overall. Starting from target setting, but actually moving also to commercialization and supporting our customer in transition, understanding client transition plans. I think maybe I'll just add two sort of points, right, to sort of this topic, right. One is I think we're all sustainable finance professionals here, right. So I think for all of us, it might seem quite obvious that this is something that we need to do, and it's just a matter of course. But I think sometimes, sort of out there, if you will, people still see this as somehow as a hobby or a side activity. And I think that's something that we need to kind of move beyond, right? Having a transition plan is not just having a transition plan. Your transition plan should equal your business strategy, right? So I think we should look at it almost as one and the same, whenever we think about it, right? Whether it's ourselves or when we talk to our clients. The other bit is that I think we do need to sort of lift the floor for everybody. And one thing that we're quite proud of is that we support capacity building initiatives, whether it's with our peer banks in the region, with our clients, or sort of to bring others along in this journey, right? I can give two examples. In Hong Kong alone, we support two capacity building initiatives. One is CASI, which is Dr. Ma Jun's group, which helps, I think, a lot of the sort of the commercial banks around the region. Another one, the Alliance for Green Commercial Banks, which is a HKMA and IFC initiative as well, right? So we really believe that actually, to really get this right, we all need to sort of move in one in some ways, and we need to sort of share our best practices and actually advance this industry forward, and in some ways make it almost a boring topic that we don't need to talk about separately. It's just going to become a matter of course over time. Thank you.
Thank you, Justin. I think I certainly enjoyed the conversation and would like this to continue, but unfortunately we run out of time and the Jun is just staring at me already. We have some interesting questions on the board, but unfortunately, again, we don't have time. Some questions like what are the US banks doing these days? I think not much, right? Look at the stage, there's no single one US banks. Well, kidding enough, I think, even from ICMA perspective, as you know, we are global, sort of like association focused on the sustainable bonds. It's not a secret that the agenda is pretty European-centric, and the European players really drive the agenda, everything. And when we sit here, it's more important to engage with our Asia counterparts, and also I would encourage certainly more regional institutions to have their voice out and how to represent their interests. I think that's important. Other questions like to engage with the Hong Kong regulators, I think it's important that you have your seat within the GFA actually, because the GFA, as you know, advise Hong Kong government to shape up the policies, and this is why we should have this association and engage with the regulators and other market participants. I think certainly the audience will agree with me that you enjoyed the conversation and also this interesting discussion with my panelists. So if you don't mind to give them a big applaud, and I will close this panel. Thank you.